So back to the question that was asked up front, the property market, residential property market at least, is going to crash. Do you agree?
I guess being one of the larger Singapore developer, the questions falls to me. No, I don't think it will crash. It's not the first time we are seeing ABSD being introduced, just that it's an increment of 5% across the board. Now, when it was first introduced, there was obviously the same question. Will the property market crash? It didn't crash. What it did was, however, it did slow the market down, and the inevitable happened. The market went back up. So from our perspective, all this does really is that it will slow the market down. But I think one must recognize that there's a distinction in the market, which often when we speak about policies, we speak in a broad fashion, a broad broom fashion. And that is within the residential market, there are different products for different target markets. Developers seldom build something just with aimlessly, to sell to everybody, right? So the higher end product will have a very different target market, and therefore a very different reaction from the more mass market ones. What I mean by that would be that you'll find that the more mass market products, you will have, if you have more Singaporeans who are buying it for the first time, being for their homes, then they're not going to be affected by the ABSD in that fashion. But the higher end product, the initial reaction from any investors, and most of this will be foreigners who are buying it, will be that they will hold back, wait and see, right? And if you look at where this new property cooling measure is bringing that to, it's basically 20% for a foreigner. And if you look at Hong Kong, which is where we often compared to, that's 30%. So from somebody who's living in Hong Kong looking at it, there's still a 10% differential. He has to ask himself whether should he get in now before it turns to 30% like Hong Kong. One of the advantages of Singapore is a gateway city to ASEAN, gateway city to Southeast Asia, and that because of its transparency of the market, its well-organized framework dealing with the legal aspects of property transaction, protection of rights and so forth, makes it a very safe market for investors to invest in. And being a gateway city, you will always have people, foreign investors who are interested. Now, foreign investors nowadays are more driven by capital flows. So I think what will determine whether they will continue to have appetite for Singapore market will be more dependent on the capital flight back to US or not, or other places. I think that probably have a greater longer-term implication than the ABSD rule, which I think will have a definite impact, but a temporal effect, which I think will eventually people get used to it and get on with it.
So thank you, Mr. Richard Lai. Of course, Mr. Lai is from GuocoLand, and perhaps after this event, we might come to you for a 5% discount voucher. What do you think, Mr. Andrew Lim? Mr. Lim is from CapitaLand.
No vouchers.
No vouchers.
Let's just get that one out the way first. I think the word crash is probably strong. I would agree with Richard on that. If you look at what the government, I think, is trying to accomplish, when you see how private property prices have come up very, very quickly in such a short time, after a concerted effort through multiple layers of cooling measures, incremental cooling measures, since they were first implemented in 2013. So I think the stat that I saw was that over the 4-year period, they achieved a drop of about 11%. And that has basically been wiped out in a short period of time of less than 12 months. So I hate to say it, but in a way, we are architects of our own situation. And I think the government and the regulators have seen this trend, and they're trying to nip it very early in the bud, in its infancy. The author of the question actually raises an interesting point. If everyone is actually a homeowner in Singapore, if there are more homes than people who want to own homes, then where is this demand coming from other than the natural creation of 10 to 12,000 units a year? The answer must be then this is speculative demand where people are buying their second or third homes. And so if I put myself in the shoes of the regulator, then speculative demand is something that rightly would cause concern. And so I think what this is again an early attempt to manage what they believe or perceive to be an increase in speculation in where the Singapore residential market is headed. So on that basis, I suppose the reaction is a fair one, although I'm sure we have very different opinions on that.
Mr. Wong Man Hoong, he represents Mapletree. Of course, Mapletree in Singapore does not do residential properties, but still, he is going to be getting some impact.
I can offer you a voucher.
Wow.
Because we don't do residential in Singapore. And there's nothing to buy, yeah. Okay, so I think my views or our views on the Singapore residential market is not very relevant. It's actually the same as what you have because we are not a developer here. But my personal view is that it's not crashing. I think it's a very strong word. And dropping from 2013, where it's a peak, 15 quarters by 11%-ish, and going back another 9 doesn't mean getting close because the base is different, right? But I think the government is very preemptive now. Where we are seeing also, we do get involved with residential in other markets, not very big, say in Vietnam, in China. I think Singapore as a very cosmopolitan city, at the high end, especially the luxury markets, the prices are not that very expensive. So if you look at Shanghai, for example, where the land lease is, say, 70 years, and it's not exactly, say, at the Bund area. Say at the northern side, you can be talking about equivalent of Singapore $5,000 per square feet, which is very expensive. So in my mind, it's very expensive. So Singapore is actually at that level fairly competitive globally. So having said that, I think that it's important that we curb any speculations, so that it's very driven by the natural demand and supply, and also the natural income of the people.
Would you expect money to be flowing into industrial office or retail space that might then affect your valuations?
I think that in the last run-up before the government acted 2011 with the policies, after they acted, the industrial space, commercial, retail, the prices did increase significantly more than the residential in Singapore, and definitely ahead of rental growth. But I think we are not overly concerned for a couple of points. One is that those are largely confined to small-scale strata space, not exactly the wholesale type where we invest. So I think we remain sensible, though, of course, every asset class, cap rate has come down. It's more expensive. It's across everywhere. I think next is that for those who had bought, some of whom are speculators, I don't think they had a good time because there are quite a fair bit of vacant strata shop lots still around. And I believe that those who bought into strata, industrial or commercial space, I don't think they're getting the rental they thought they're getting to justify the price. So I think with the experience, I'm hopeful it doesn't spill so much into the other space we operated on, but generally cap rate remains low.
Okay, so now we've got another 3 questions related. So other than money being squeezed out of residential into potentially industrial, commercial, money could also flow into Iskandar. So 2 questions here. Do you think more investors would consider buying abroad, especially in Iskandar? And then more specific to Andrew, CapitaLand bought a big piece of land in Iskandar next to Danga Bay. Are there development plans already? And since the ringgit is at a low, will you be developing it anytime soon?
We can offer some vouchers for Iskandar if you like. Our view on Iskandar is to essentially take a wait-and-see approach. I think if you look at what is happening in the southern tip of Johor, with a lot of development in the last 2 years, Chinese-led development in the residential space, we have a very large plot. The advantage that we have with land in Malaysia that we don't necessarily have in Singapore is the virtue of time. And so in a traditional developer model, you have the ability to land bank, and you decide when the right time is to develop that land. And so we are blessed with that ability in Iskandar to take a wait-and-see approach to see what the secular trends in southern Johor turn out to be. And we think they are positive because if you look at southern Johor and how it is linked and tied to the fortunes of Singapore with our demographics and the ability for people to perhaps look for landed properties more affordably, a stone's throw away from their homes, then there becomes an interesting story that may take 10, 12, 15 years to unwind or to tell itself. So we're in no hurry to push the button on Iskandar. We like the fact that we have an option there that essentially we can exercise whenever we feel the time is right.
I think we've all been down this road before. I mean, the first time when ABSD was introduced, of course, a lot of people were looking at properties across the causeway into Johor Bahru and Iskandar and so forth. I think at the end of the day, with the introduction of more costs to ownership of property in Singapore, yes, you certainly can expect buyers and investors to look harder, search the world, explore things a little bit more to try and find better value. That will always be the case. Whether that is Iskandar or not is an entirely different story. But I think that certainly people should be doing that and shouldn't be just looking at one single market and making a decision purely on that. So that's going to be part of the reason why I think the market will slow, simply because people will do more of that. You start thinking about, should I invest into Manchester in UK, instead of investing in Singapore or things like that. And I think buyers beware, so buyers should really do that.
Okay, so the next question then is, with this new set of rules, is the Unblocked Market dead? So what's your advice for somebody who is in the process of forming and signing up the Unblocked to the 80% mark? Would reducing the reserve price by 5% or giving discount vouchers equal to 5% good enough to attract developers back to bidding for the Unblocked?
Try and see.
Or that we just did one yesterday.
Yes, it was announced yesterday.
But that was done before and it will be completed before the new rules kick in. So we get away with that one. But you will notice prior to the last Thursday that the prices in terms of number of bids, what is not shown, and Tan Sri Rafidah Aziz was quite right to say just now, what you don't read in the press, what you don't read in the news, obviously, is that how many numbers of en bloc actually fails to take off. That people don't talk about. And in reality, there have been increasing numbers of en bloc that people want to en bloc, but they are unsuccessful in doing so. And people don't talk about that one, right? What we have been discovering is that increasingly, you can bid below their reserve price, and you might still end up with a property. So we are starting, we started to see some plateauing in the prices there, and some cooling in terms of desire to bid for these en blocs even before last Thursday. So if you ask me, I thought last Thursday wasn't necessary, but we can debate and argue about it. I don't think the en bloc market is dead, but I think buying something in the right place, location, is very important, and you must be able to develop a right product out of that. And if you're able to have the right product in the right place, you will have a robust market for it. Somewhere along the line, there will be people interested in it. I think where people were concerned about, where the regulators were concerned about, was that they started to see price escalation, the bids for places that they didn't think was supposed to get that sort of prices, but it got that sort of prices.
Park House, for example.
I wouldn't name names, but you know, you're out there in the market, so you know that what I mean. And I would say that a lot of that is more to do with pent-up demand from developers who are running out inventories. And that was the result of having many years of not having sufficient supply coming out to the market to begin with. So that has completely different dynamics to it. And one doesn't throw in new measures just because of that, because people were getting satisfied, the developers were getting satisfied. That's why you started to see a drop in interest for en blocs. You started to see a drop in terms of number of people bidding for sites. Now, good sites, you will always get that, but the poorer ones, you will started to see some degree of realism coming into the market.
The last list I saw was about 15 en blocs completed and put out for tender, but at the end of the tender date, there wasn't a confirmed winner. Yes. Perhaps with this set of new rules, Lim Square might look much more attractive as an en bloc. Would Mapletree buy Lim Square?
We haven't talked about that, to be honest. I think where Mapletree focuses on, actually now we look at more at the global business. So I may just switch a little bit, is that I think one problem in Singapore, which we face, I think most developers face, is that although the system is very efficient, and really trust me, the governments may grab about it, but to really get something off the ground developed is very fast, even compared to Hong Kong. But we find it very difficult to grow because prices has gone up so much. When there's something out for bidding, we see the whole town there, GLS, whatever. So I think the point is that even in Asia, it also can be quite limited to find good opportunities. So we do grow overseas into the US, in Europe, UK, Australia, Japan, where we find that there are more opportunities, more institutional markets, more liquidity in real estate, and we believe we can get something that's, from the cash flow perspective, makes sense for us. So I think we haven't talked about Lim Square, and we need to, if anyone bid, I'm sure the price is very high. So we probably will not.
Okay, so since we are on the point of, another question. Okay, this is a follow-up then to the first question. So since we agree that the property market won't crash, so what is our expectation for price increase, say, in 2019?
My crystal ball not that clear. I can't.
my glass is half full.
Mine is half empty.
Okay. So since we are on the point about overseas expansion, maybe I would really like to take this opportunity to learn from the panelists, and I think many of you finance professionals are also thinking about what are your strategies then for your global expansion over the next 3 to 5 years? Where would your footprint grow into, or where would you be expanding your footprint outside of Singapore? Perhaps we start with Richard.
I think, well, we have different dynamics here. Of course, Mapletree has got different type of product they look at from what we look at. So for us, being a developer, although we like developing integrated developments, residential continue to require a big part of our business. So obviously, we are very much attracted to places where there are geographic reasons to be there, whether it is because of population growth, more increasing urbanization, or shift in terms of population base. So in that respect, China continued to be a very interesting place for us. In spite of all the things that we've been hearing, we are still quite bullish about China in the long run. We do recognize there's a bit of uncertainty that has crept in the market, which is not necessarily a bad thing if you are looking at in the long term. We would say that even UK market in the long run is not a bad market, but we do recognize that they are going to be facing a lot of uncertainty in the near term. So I think we will be very selective about where we look at and where we go. But obviously, for us as a developer, we like to go to places that we have some clarity how things are done. Because we've been in China for the last 10 years, we feel comfortable with China. If you ask me to go to a new country like Indonesia, it would be like going to China 10 years ago. Like we will have to learn all over again. And that's something we could consider with the right partner.
Andrew?
You can look at a global strategy through multiple lenses. I'll focus on two of them. One is the residential market, since we are very keen on that. So at CapitaLand, we have three key residential markets, Singapore, obviously, China, and Vietnam. The reason the Singapore residential market only constitutes about 3% of our business today is that from a risk-return perspective, we actually see much better value and opportunities in Vietnam and China. And so we took the decision when cooling measures kicked in 2013, actually, to de-risk our position in Singapore Resi. And so I think today, if you ask me where we would continue to focus our residential business, it would absolutely be in Vietnam and China for the reasons that I think Richard mentioned on China. And Vietnam, to us, actually, we look at a city like Ho Chi Minh and reminds us very much of Shanghai 10 to 12 years ago. Demographically, very, very exciting. You have a lot of FDI coming in. The Vietnamese government has, I think, learned a lot of the lessons from the GFC 10 plus years ago. And they take a very pragmatic view and a very sensible view to developing the property market. They are building in safeguards, which is very commendable for emerging markets such as Vietnam. So if we can get comfortable with the FX and the structural friction of getting capital in and out, Vietnam and China remains key markets for us from a global strategy perspective. The other lens I'll briefly talk about is the diversification of risk. And I think Man Hong made a great point about looking overseas into the developed markets, which have a very, very different risk-return trade-off. These are markets that tend to yield lower returns, but play a very, very important role when you are portfolio building in terms of a global strategy and managing your risk across different markets and geographies.
From Mapletree perspective, I think for reasons I articulated earlier, back a couple of years, about 5 years ago, we looked at the environments in Singapore and in Asia. We decided in order to grow, we have to venture further. So we went into US, Europe. I think we are now in 12 economies. We have already gone into where we think we want to grow. The next step is to get deeper into the various markets. Asia remains the core. It's core to us, definitely, no doubts about that. Singapore is important. China is a big market. Really, at the end of the day, is to find opportunity that makes sense for us. Because we as a group are very focused on cash flow. We try to look into the rental growth. We try to look into whether it's continue to be relevant to our tenants. So when we go overseas, we just completed a portfolio, actually fairly big, in the US of logistic warehouses, very much really tapping into e-commerce space, tapping into the growth of logistics. So we are quite happy with that. It's a short time, but as of right now, the renewals they are seeing are above where we are feasibly studied. So we're actually revising up our assumptions too. So I think we do see a lot of, in a way, valued parts, but we had to be quite careful. But cash flow, as well as where the pricing are, is important for us to grow.
By e-commerce, are you taking advantage of the trend in e-commerce through warehouse and logistics, or including data centers?
Okay, for us, I think that there's a lot of talk about, say, disruption and technology affecting, say, retail. I think that is definitely, and it's a structural change. It's not turning back. I think where benefited is both, especially on warehouse that are catered towards e-commerce. The reason is that e-commerce retailers, they use a lot more space than your brick and mortar. Return, for example, is as much as 30%. I mean, some places I'm aware that you're not sure your size. You order 2-3 sizes, you can return. You know, so there's a lot of space. Inventory turnover is very high. 2 is that we are moving the storage space from the shop front to warehouse. I think 3 is that in order to be competitive, the customer satisfaction is very important. So the speed of delivery to the customer is need to be very fast, same-day delivery. So what it means, supply chain must be very strong. Warehouse, distribution centers are important. So we see there's a growth area. So we do participate through that. Data too, the speed that's not necessarily just e-commerce, but just pure data. The speed that we create data, we copy data, Internet of Things, cloud computing. So the rule of thumb is that perhaps the volume of data doubles every 2 years. So the data center services are therefore also important, so growing quite well. So I think one could also participate in the space to in a way participate in the growth of the technology.
Andrew, you are a big owner of shopping mall space, so with this point about e-commerce structurally changing retail space, is it bye-bye to Orchard Road, the shopping belt?
No, it's not bye-bye to Orchard Road, but I think Orchard Road and the retail sector as a whole is also similarly looking at structural change. I think if you look at real estate, regardless of whichever sector you are invested in, you have to satisfy yourself with the reality that structural change is here. And it takes, disruptors are coming in multiple directions. They are not coming from the real estate space. They are coming from areas that are unbeknownst to us right now, as the gentleman in the previous panel talked about. The reach of the technology-based disruptors is multi-sector, it's omni-sector. So in retail, we believe firmly, first of all, that bricks and mortar is here to stay. It is not the death of the shopping mall, but the evolution of the shopping mall into something that we believe is much more community-based. And that is, I think, something that still rings very true in Asia in general. We see this across our retail platform in the 5 countries which we operate, most notably in China and Singapore. If you go down to the malls on the weekends, you will see that for the most part, they still remain very full. Footfall is robust, and sales remain high. They're very resilient. But we cannot deny the fact that the retail product is changing. Customers are looking for a place to congregate as a community. And so you cannot, as a landlord, just blindly let out your spaces in the hopes to earn the highest rent possible. You have to look at the space and design a community that people want to hang out at every weekend and after work and so on and so forth, to bring their children and so forth. So I think this is a theme that I'm sure all of you are very familiar with. We look at our retail platform as an opportunity to design a location that is hopefully at the node of a major transport hub, has a wide catchment area that allows for as much footfall as you can deliver. But most important, the space itself has to give people a reason to come. Because if you are just talking about your regular commodity products, these will migrate online. I think that's a given.
Okay, so I wish you good luck in developing more community-centric type of a product in your retail space. Let me give a quick call to PA to ask them to shut down some of the community centers later on.
Well, you mentioned community centers, and I think this is one area where developers in Singapore particularly have to pay more attention to what the government is trying to achieve in looking at how the heartland and the precincts are being developed. They're taking a very holistic approach. So we can't look at a retail space or a shopping center and say this is just a shopping mall. It has to encompass all facets of what people want as a place to go. So you bring up community centers, that's a great example. Why can't a retail mall encompass a community center, encompass a library, encompass a healthcare facility, encompass childcare, child enrichment? If you can pull all of these things into the right space in conjunction with the master planning authorities, then I think you have a viable product that can stand the test of time.
Yes, then car park will be the next issue we have to discuss later. Richard, about your mixed development, so what sort of adjustments are you making then to the retail component of your mixed developments?
I think in terms of if you talk about retail per se, creating a experience is what people are looking at, and that's one of the reasons why F&B has been continue to be such a big draw, because while you can order your food and eat at home, is a different thing to be going out somewhere to sit together with your family and things like that to enjoy a meal. So it basically means it doesn't disappear. You continue to have brick and mortar malls and things like that. It's a question, of course, is what do you do with those space? The space are neutral. You just have to adapt to what the changing dynamics are going to be. I think in terms of the residential component, however, I think that has still got room to change. Because right now, you talk about online marketing, right? Taobao and things like that. You order something, when it comes to your home, you're working. So what do you do? And I know that some of them have created pop-up lockers and things like that in the malls where you can go and collect, but not everybody uses that, right? And you have got, if you come to your condominiums, you've got only mailbox, and your security guard doesn't always want to accept your parcels. So you're going to have these challenges there. All these challenges are real. So the question is then, what do developers like us do about it? And that's what we have to, in designing our new products and things like that, we have to factor those things in creating the avenues for parcels like this to be collected, kept, and delivered, or things like that.
I want to just add one point. I think putting in perspective, I totally agree with Andrew that the Orchard Road shopping belt remains very relevant. I think Tan Sri, Andrew Shen, you show a chart just now on the e-commerce. Where we observe is that different country has different characteristics. In China, e-commerce is very serious. It's very serious. US similarly, but somehow in Singapore, say in Hong Kong, we really feel less impact on that. These are like for our REITs, they are listed, so the numbers are reported. For example, Vivo City in Singapore or Festival Walk in Hong Kong. There's no one year that revenue has ever dropped. None of which. They continue to grow, perhaps slower. So I think somehow it's not as serious, but I think in those spaces that we participate, say in the US, in China, logistics side, the e-commerce growth is a phenomenon. It's just a habit of people now of those places. So the retail space will need to really rethink how to use it and try to get the value from per square foot. I mean, if we just change to be a kind of office space, or it may not be that high value. So that's something which we need to think very hard, how to convert.
It's just two quick points to add to what Man Hoong was saying. When we go on the road and we talk to investors who are very concerned about retail, they are hearing the horror stories coming in from the experience in the West, so the US, Australia, and they transpose that into Asia, and the question is, so is this what I'm going to read about next year in your malls in China and in Singapore? And we see a very different experience. I think there's a couple of reasons why. First of all, when we are talking about the US and Australia, we're talking about two markets with extremely high density in retail space per capita. I think the US is number 1 and Australia is like number 2 or 3. So that in itself suggests that there's an oversupply and that it is ripe for disruption. And so what you are seeing in the US and Australia now is that these malls who are parked there in the suburbs with a cookie-cutter series of stores that sell commodity products. These are the malls that, as disruptors come in, have no reason for being there. And that will be a natural evolution of the retail space. So as Mang Hoong is mentioning, there are actually investors now going to pick up these malls for the sole reason of repurposing them, and in terms of, for example, co-working spaces, logistics facilities, because the locations of these malls are actually pretty good. because they're originally built there because they believe that it's convenient for people to visit the mall. So it's just, I think, a natural evolution of where the product is headed, and we must be very mindful of that when we look at how we design the product here in Asia. But it is not fair to take what is happening in the US and Australia and just transposing that blindly into the Asian context.
Okay, so without knowing it, we've actually moved into the issue of tech disruptions and how developers are changing the way they work because of lifestyle changes and due to technology disruptions. But before that, let me interrupt with yet another question around the four-letter word. How do the new ABSD and TDSR measures affect your pricing strategy and then your profit margin targets? So I'm guessing that this would be more applicable to GuocoLand, not so much because CapitaLand has only one more major residential development in Singapore, which is the Pearl Bank Unblocked.
I think okay, let's take the second question first. How would they affect our profit margin? And I would say this. I mean, if you take a look at Martin Modern, which is the one that we launched last year. When we started, it was about 2,002 per square foot on average. Where we ended before Thursday's announcement was about 2,008 per square foot on average. If you compare to a year ago, and all these are all relative, right? You compare to a year ago, I would say that our margins have improved a lot. So if I have to absorb 5% for the transition, it's not going to hurt us badly because you have had an increase in price. Now, whether are we going to do that, that's another question altogether. Yeah? But certainly it's not going to, it just means that we are going to make less money, but it doesn't mean that we end up losing money, and that's the important thing. I think the Warwick residence, for example, which is heavily bought by foreigners, and that's the one that a lot of you have read in the newspaper talking about $4,000 per square foot and so forth. I can say like yesterday we were still closing deals, and we were closing deals because some of these foreigners were kicking themselves or delaying so long in making a decision that now they felt if I don't sign soon, it might turn to 25. Before I know it, 30%. So the mentality is a little bit different. Huh? They're buying for whatever their own reasons might be. So are we going to be a little more lenient on the pricing in view of all these things? Yes, we probably have to be more flexible. But are we going to do massive cuts or things like that? No. I think we will be more selective about the units and what price we want to sell at those units. Obviously, the less advantageous units will be a lot more flexible than the more advantageous units, and that's what it will mean. Okay. Bearing in mind, we were selling Goodwood residence and Leiden residence even through 2013 back in those periods. Leiden later, Goodwood that was during that time. And we've been selling them through a relatively slow market as well, and we've been successful in selling them. So we don't think it's anything frightening, but it's just something you have to live with.
I guess that's the answer coming from a financially and credit strong developer. But for the credit less strong people borrowing at 6 to 7% in the bond market, maybe that situation could be.
Yes, if you're very highly geared, then you might get a bit more worried because you can't you can't monetize inventories. Then you start to be a lot.
On that happy note, would you be willing to give everybody in the audience a 10% discount voucher?
That's not for me to say.
Okay, I suddenly realized we are actually almost at the end of the discussion, and then there will be a cocktail session later on. So things that we are not allowed to discuss on stage, and if you want investment tips, please catch our panelists outside. Would you want to have a final sharing of what you think might be happening in the next few years, where strategy tips in terms of borrowing and financing or hedging for the next few years? Manu?
I think there's I think the environment is there's always volatility in the markets. Whenever, I mean, like 3 years ago, 5 years ago, we were thinking there's volatility. interest rate will go up. I think interest rate will go up. It's a matter of when and how fast it will be. So I think the important things that we always focus on is cash flow. The demands for the space that we have, what kind of supply is in the market. So whether the rental growth can't go fast enough in order to offset that. I mean, interest rate increase, cap rate can also increase, so value can come down. So I think we stick very close to that. So we are very, very cash flow driven, and I think that fundamentally, that must be the sound thing to do. When we finance it, we also are very careful about the FX exposure, especially capital side. If you really look at the data, FX is more volatile than the underlying real estate value. So you may make money from your real estate in local currency term. You lose money on FX if you do get out. So I think we have to plan for that. So it can be expensive to hedge, but I think it's the policy that one probably need to stick to, for those markets. So I think it's important, cash flow, fundamentals, and really manage the risk. So I think that's what we do, and I think that way we can be more comforted that a business model will continue to work.
I'm sure Wei Min's team will be very happy to structure a FX-linked loan for you. Andrew?
I think that's absolutely right. I think when you are faced in periods of uncertainty, and when uncertainty and volatility are heightened, you have to go back to core principles and remind yourself to be disciplined. So the good things that we have been doing all these years in not being FX speculators, watching our interest rates, watching our overall debt levels, watching our country exposures, watching our sector exposures, concentrating on cash flows. These are all things that you underline twice in the situation like this. Maybe just to add that, someone's, I hate to say that, but someone's misfortune is someone else's opportunity. I think this translates to multiple languages. But so we see ourselves in a period going forward 12 to 18 months where there could be a lot of opportunities surfacing in multiple geographies, given the uncertainty that we have. So if this plays out, this could be a very interesting time for companies who are disciplined, remain on the lookout for interesting opportunities. And we'd like to think that we are one of them.
I cannot, I can't say much more than what my two esteemed colleagues have already said. I think it's absolutely important to buy well, and I think the next, we've been hearing about volatility being the norm, the new norm. Well, 10 years ago, back in 2008, after the Lehman Brothers crisis started, and when that supposedly ended, we have been seeing that sort of volatility, and guess what? It's still here. And guess what? It will continue to be here. So I think that all this volatility will definitely give rise to buying opportunities. The important thing, however, is to buy right now. Be clever in what you're buying. If you're, whether it's investing into a bond or investing into equities or buying a property yourself, if you're buying right, you can rest easily. So I would be very careful taking very big risks in the markets ahead. But there are good products in good locations which you may have to trade off a little bit in terms of what sort of yields, what sort of returns, but at least you know that in good times or bad times, those products won't let you down.
One more sound advice that I'm sure is in every one of your heads, but you have forgotten to mention, is that you should also be, in this volatile market, borrowing from a very strong bank such as OCBC. On that happy note, thank you very much. Please give our panelists a round of applause. See you outside at the cocktail session.